It was a surprise. Certainly the employment numbers were stronger than expected, and in particular, of course, that unemployment rate fell quite sharply, and now it's at a 9-month low. And that is consistent broadly with our view though, on the economy. We'd seen over the past few months that the labour market wasn't really continuing to loosen much. The unemployment rate had been steady and so on. And with that, we've had the view that we didn't think the RBA would be in a position to cut interest rates anytime soon. Our view is that they won't get to cut rates until probably the middle of next year at the earliest. And there's at least some chance in our view that the RBA may not get to cut interest rates in 2025 at all.
Why does the RBA want to see more people out of work before it cuts rates?
Well, I don't think that's the way the RBA sort of frames this. The RBA's got an inflation target. They're trying to get inflation down, and core inflation is still well above where it needs to be. In order to get that inflation to come down, you need to see wages growth slow down. And the way wages growth slows down, of course, is if the labour market continues to loosen. So those are the sort of ways that the RBA thinks about this. This is a signal that the labour market is no longer loosening. It looks as though the unemployment rate may have peaked, and if it has, then that's telling you that wages growth may no longer continue to slow, and it may be hard for them to get inflation in that last mile, back from 3.5 right down to 2.5, which is their target.
The monthly job series can be quite volatile. Could the November reading just be an anomaly?
It's always the case that these numbers bounce around quite a lot at a monthly level. But these numbers are probably a little bit less affected by seasonality than some of the numbers we're about to get, actually. We're going to get some numbers in early January for December and then February for January. The numbers have been really quite volatile in recent years around December and January because the seasonal patterns have been changing, the hiring patterns have been changing post-pandemic. These numbers are probably a bit more of a reliable gauge. So I think there's some information in this that we need to really take heed of.
We will get more jobs data and the quarterly reading on inflation in January. What would the RBA need to see in those numbers to trigger a February rate cut?
Well, the key focus is going to be on that CPI print that you referred to, the fourth quarter print that we get in late January. If it's low enough, it would open the door for the RBA to think about cutting rates. But today's numbers, for the labour market at least, tell us that even if that inflation number turns out to be quite low, if the labour market's now tightening up, it might make the RBA quite hesitant about delivering a rate cut. And that's our central case. We don't think that we're likely to get a cut as early as that. We think a cut will be further into the year.
Your forecasts put a 1 in 4 chance on no rate cuts happening at all in 2025. What would it take to cement that view? So
the way we get there is we think that this very slow grind of inflation falling will continue to be a slow grind. Inflation will continue to fall quite slowly. That the jobs market will no longer loosen any further, and that's not going to put any further downward pressure on wages growth. And then we've also got to look globally and think about what's going on in terms of global inflation. When we sort of weigh up all those factors, we think there's a chance the RBA might miss this easing phase altogether, having lifted interest rates by less than everyone else, slowed the economy by less, being still close to full employment, inflation's falling quite slowly. Maybe that will mean the RBA just doesn't get to cut. And yes, we've ascribed a 25% chance to that being a possibility in 2025.
Paul Bloxham, thank you so much.
Thank you.